I want to open with a number, not a headline, not a hook, just a number. 46,546 shares of Mara, down 44% at the trough. That is roughly $267,000 in unrealized loss sitting on one position in one account. I have been running this account publicly on Tiger Brokers for over a year. This is what the screen has actually looked like. No music, no build-up, no carefully timed reveal. Just the number. And today I am going to walk you through exactly what happened, what I did, and what I am rebuilding. Mara dropped from the mid-teens down to a 90-day low of $7.31. Coin was cut in half over the same stretch. BMNR more than halved. This was not a single crash event. It was a slow, public, 12-week bleed. The Iran war headlines, the Nasdaq correction, and a crypto cycle rolling over all hit at the same time. Every week brought a fresh low. Every Monday opened with the same question. Is this the flush, or is there more? For 12 weeks, the answer was, there is more. That kind of sustained drawdown does something to your decision-making if you let it. Here is the honest picture of what the portfolio looked like. Mostly Mara and Coin, with some SPY hedges layered in. Not a diversified book by any standard definition. A concentrated crypto equity wheel. When Mara was trading at $20, that concentration worked beautifully. The premium was rich, the position generated income, and the account grew. When Mara dropped to $8, the same strategy produced a completely different result. Same mechanics, same rules, same execution. The strategy did not change. The underlying moved, and the concentration meant there was nowhere to hide. That is the setup. That is the honest version. Here is the part most traders miss, and I say this as someone who missed it himself. The strategy was not broken. The position sizing was. There is a critical difference between those two things, and conflating them leads you to discard a working edge because you could not separate the method from the mistake. Same wheel mechanics, same probability framework, same premium targets. Completely different outcome because one or two names were deciding whether the whole portfolio survived or struggled. If your strategy works in calm markets but falls apart in a drawdown, the problem is almost never the strategy. It is the concentration. There was no single dramatic moment. No screen flash at 2 in the morning, no panic close, no one phone call that changed everything. It was slower than that. Just a quiet acknowledgement building over several weeks of reviewing the book and asking the same question. Is this sustainable? The answer kept coming back the same. The concentration era had to end. Not because the wheel failed as a strategy, not because the premium stopped arriving, but because no strategy, however sound, survives intact when a 46,000 share position goes the wrong way at the wrong time. The strategy needed a new constraint. That constraint is position sizing. Here is the part that almost never gets discussed in drawdown stories. While Mara bled for 12 weeks, the wheel premium kept arriving. Every expiry, every week, without interruption. Even at the lows, with Mara trading between $7 and $8, the 30 Delta cash secured puts were still paying approximately $2,000 a week once contract counts adjusted to the lower price. Not glamorous. Not the kind of number that goes in a highlight reel. But consistent. The underlying was losing ground. The premium was not. That distinction matters more than most people realize when you are trying to decide whether to keep running the book. Higher volatility means higher premiums. That is mechanical, not opinion, not a thesis. It is just how options pricing works. With VIX spiking past 30 during the drawdown, every cash-secured put and covered call sold earned measurably more than the same strike would have earned in a calm, low-volatility market. Cumulative through the 12-week bleed, roughly $25,000 to $30,000 in collected premium. That did not cover the unrealized Mara loss. No amount of weekly premium was going to do that on its own. But it kept the account functioning while the underlying repriced. The math was paying me to wait. I just had to keep running it. Let me be direct about what the rebuild is and what it is not. I am not pivoting because the strategy failed. I am rebuilding because the sizing failed, and that is a different problem with a different solution. The instinct after a drawdown is often to change the strategy when the actual problem is the position architecture around it. The wheel is staying. The premium engine is staying. The Mara concentration is not. There is a meaningful difference between abandoning a strategy that works and correcting a position that got too large. One is rational. The other is just reaction. The new mandate is one sentence, and everything downstream flows from it. No single name decides whether the lab eats or starves. That is the rule. Everything else, the strategy selection, the counter selection, the AI layer, the EV engine, all of it serves that one constraint. It sounds simple. It is. Most of the best risk rules are. The implementation is where it gets detailed, but the mandate itself does not need to be complex. Write it on the wall. Filter every trade through it before it goes on the book. If a single name could decide the month, the trade does not go on. The engine has a clear structure now. 3 strategies, scaled by market regime. PMCCs for trending markets where directional exposure earns. Front spreads when implied volatility is elevated and the structure pays for selling the wings. The wheel grinding steady premium across both regimes as the base layer. 2 counters, not 20. MARA as the high volatility income counter where the premium to price ratio justifies the position. SPY as the steady, liquid, broad market base. Everything else rolls off as positions expire. No accumulation of leftover single name exposure. 1 crypto equity counter, 1 broad market counter. Clean, legible, concentrated on purpose rather than by accident. The decision layer is not vibes. It is not a read on whether the market feels toppy or whether the chart looks right. It is an expected value calculator. The engine takes the strategy parameters, the current volatility regime, and the state of the existing position, and it scores every potential trade by its probability-weighted expected value. The trade either clears the bar or it does not. There is no discussion, no override for instinct, no adjusting the inputs because you want the trade to score well. Math, not mood. That is the entire design philosophy, and it is the whole reason this channel is called Mathematical Money. I need to be direct here because there is a lot of noise in this space. The AI is not picking trades. Let me say that again. The AI is not picking trades. The strategies pick the trades. The EV calculator scores them. The AI does not find winners. It does not predict direction. It does not have some edge the market has not already priced in. If anyone tells you their AI picks winning trades for them, you should be genuinely skeptical, because that is almost never what is actually happening. What you are usually looking at is a backtest that fit the data, not a forward-looking edge. What the AI layer actually does is enforce discipline, and in options trading, discipline is the edge. Tiger Brokers API integration for live position data. Position sizing calculated within predefined concentration limits before any order is placed. Regime detection updating the strategy weighting automatically. Order routing. The boring, repetitive, emotionally neutral work that humans do poorly when they are tired, distracted, or excited after a winning streak. The AI has one primary job in this system. Stop me from ever building a 46,000 share, single name position again. Enforce the mandate automatically, without negotiation, without override. That one function alone justifies the entire build. The backtests look encouraging. I will share the full numbers once they have been properly stress tested and the live system has had time to run. But I want to be precise about what a backtest is, because this matters. A backtest is not a promise. It is not a guarantee that the next 12 months will look like the last 10 years of historical data. Markets change structure. Regimes shift. What a backtest does give you is evidence that the rules have logical, mathematical grounding, that the edge is not imaginary, and that the system has survived varied conditions. That is all. That is enough. Anything more is overselling it. I am sharing all of this publicly for one reason, so you can watch the rebuild happen in real time. The system wiring, the EV engine going live, the first trades the AI layer actually executes and monitors, all of it on this channel, in real numbers, with real positions. If you have been burned by concentration risk this year, or if you are simply curious what AI-assisted options execution looks like without the grifter noise around it, this is the channel for that. Subscribe. Come back for the next post when the live numbers start arriving. Stop guessing. Start calculating. Let's go together.